India's stock markets have staged record-breaking rallies this year, making the country a favorite among its Asia-Pacific counterparts. The Nifty 50 index has repeatedly notched fresh all-time highs, reaching yet another peak on Tuesday. The index is set for an eighth year of gains, up more than 15% year-to-date. Optimism about India's growth prospects, increased liquidity and greater domestic participation have all contributed to the surge in stock markets. In fact, India's stock market value has overtaken Hong Kong's to become the seventh largest in the world. As of the end of November, the total market capitalization of the National Stock Exchange of India was $3.989 trillion versus Hong Kong's $3.984 trillion, according to data from the World Federation of Exchanges. Numbers from the WFE also showed that India's NSE saw more new stock listings than the HKEX. India's stock market had 22 new listings versus Hong Kong's 7, as of November. Here are the 5 reasons why India's stock markets have reached new highs this year. India has been one of South Asia's fastest-growing economies, with expectations only building up for next year. The world's most populous country has grown at a consistently strong pace this year, with the most recent reading on third-quarter GDP showing a much higher than expected growth rate of 7.6%. Bets on India driving growth in Asia have also been rising. S&P Global predicted India's GDP for the fiscal year ending March 2024 hit 6.4%, more than its earlier forecast of 6%. The Indian stock market has also shown sound fundamentals and robust earnings, which are expected to grow through 2024. HSBC forecasts earnings growth of 17.8% for India in 2024, among the fastest rates in Asia. Sectors such as banks, healthcare and energy, which have already done well this year, are best positioned for 2024, according to HSBC. Sectors such as autos, retailers, real estate and telecoms were also relatively well positioned for 2024, while fast-moving consumer goods, utilities and chemicals are among those HSBC said were unfavorable. There has also been an uptick in domestic participation in Indian stock markets this year, especially in high-growth areas, according to research by HSBC. While foreign investors tend to be active in large caps, it is local investors that dominate the small and mid-cap space, which partly explains the outperformance. Fund flows into midcap-small schemes of domestic MFs, i.e. mutual funds with a mandate to invest in small, midcaps, have been disproportionately high, HSBC noted. It also expects this trend to continue into the next year. The Reserve Bank of India held its main lending rate steady at 6.5% last Friday and said it expects the country to grow at a pace of 7% this year. The central bank did warn that inflation, even as it continues to cool, still remains above its target as underlying price pressures were stubborn. That, however, does not mean market players aren't expecting rate cuts next year.